This news story is absolutely ridiculous. Only in the age of TikTok amateurs and wannabe Instagram financial gurus could we possibly get a comparison between funding a 401k and a life insurance plan. There's 3 reasons why there's no insurance advisor or financial advisor in this world that should be comparing life insurance and 401k as comparable financial vehicles for your money. That's right, I'm out the water today and out the office. It is the Chesapeake Bay Trash Cleaning Insurance Advisor here, Austin Lewis, managing broker and owner of Bay Life Brokerage. First, and the biggest, is that life insurance is insurance. Every dollar you put in, yes, buys you multiple dollars of insurance coverage, but when it comes to cash accruing policies and even the quote unquote specially designed whole life policies, the actual cash value that's associated with that account is going to be roughly half of every premium dollar you make. So you put $1 in, you'll probably have roughly 50 cents that will reflect in your cash value. Because of course, part of that money has to go to actually pay for the insurance coverage, the actual product. Obviously, very much so unlike the 401k, where every dollar that you put in is going to be reflected directly within the actual account. Second, let's talk about what kind of dollars these actually are. See, a 401k is what's called a qualified retirement fund, right? It means the government is allowing you to place this money out of your check, out of your salary, without being taxed, into this account to be invested and compounded interest until it's time to take contributions. Main purposes of this feature is the fact that you have a much greater compounding effect on obviously money that has yet to be taxed. Life insurance plans are funded with after-tax dollars unless they are part of a IRA like a 401k. So not only does not every dollar in there reflect, but the dollars that do reflect is what you only have left over after you've already paid taxes on that money. Fees. Now you might think this is an argument against 401ks. What you don't hear these TikTokers saying is that life insurance also comes with fees. You see, the insurance company wants to hold that money, of course, right? That's how they make money. In order for you to get that money back out of your policy, you have to either do it as a loan or as a withdrawal. Loan, of course, comes with a loan interest rate. You will be paying an interest rate to the insurance company for them loaning back your money. Now, if properly planned, this can be mitigated. One of the huge gripes being used against 401ks by some of these influencers is the idea that, the government isn't even allowing you to access this money without being penalized until age 59. Of course, yes, this is true because, again, this money has yet to be taxed. You know, the way the government funds itself. But there's also a penalty if you were to withdraw money out of your life insurance before a certain period. This is called a cash surrender fee. And what that means is that within this policy, usually within the first 15 years, there is a fee schedule built in called the cash surrender value, which is going to differ from the policy value or the actual account value that you're receiving interest on. And that difference is going to be the fee that they remove from the policy value if you were to actually surrender or withdraw a portion of that cash. So let's recap. In a life insurance plan, every dollar you put in is going to be cut roughly in half when it comes to what's going to reflect in your cash value. First, have to pay taxes on that money, and you cannot withdraw or surrender or cancel that money without having an additional fee charged against that money. In comparison to a 401k, every dollar contribution does reflect in the account and is usually followed up by some sort of employer contribution, aka free money.